Company retirement plans, that you can control. You can't control the weather, you can't control the stock market, you can't control hiring policies by HR departments, you can't control Social Security Administration, but you can control what you do in taking advantage of company retirement plans. They're a wonderful benefit. When you put money in, you put it in before tax, you save your highest tax bracket. If your company puts money away for you, you're not taxed on it. The company gets to deduct it, and you're not currently taxed. You're only taxed when it comes out. You're not taxed on the earnings on your contribution. You're not taxed, bless you, you're not taxed on the earnings of the company's contribution. Only later in retirement, and you decide how you want to take it out, then you're taxed. Use it, pay tax. Don't use it, let it compound tax deferred until you're 70 and a half, and then you have to start taking out roughly 4 or 5% a year. That's not bad. That's a bargain. Two types of plans only, defined benefit, defined contribution. Defined benefit plans are a dinosaur. They're disappearing. You saw UPMC started the trend locally. They disbanded their defined benefit plan. They're costly for companies, and they're not a good deal for most employees. If you take two 21-year-olds right out of college, put them to work, one with a defined benefit plan, one with a 401k plan, the 401k kid's going to retire a lot wealthier, assuming that the money's invested properly. But the defined benefit plan works just like Social Security. It has an internal rate of return which is exactly the same. It's the Pension Benefit Guaranty Corp's rate, which is equal to the treaty rate, which is equal to the Treasury rate. So it works the same way. No, thank you, let me manage my own money. Defined benefit plan has seemingly great opportunities. No matter how you blow the money, next month at your mailbox, here's another check. But it has tremendous negatives associated. The benefit level doesn't rise unless you're a government employee with inflation. The benefit is taxable with no opportunity to defer or shelter. So if you don't need it, you still take it and you still pay taxes. Whereas if you're taking it for a 401k, you don't need it, you leave it in, you don't pay taxes. Crediting rate is what I said. When worker and beneficiary die, that's the end of the defined benefit plan. Think about that one. That's a heck of a bet. In the 401k, I can use it, Janine can use it, what's left goes to the kids, as long as we manage it properly. Benefits older workers over younger, and it's very high cost to the company to maintain. Defined contribution plans, tremendous benefits, we know it, I'm not going to belabor it. The negative, you got to be an adult. You got to manage it properly. You can't, bless you, you can't go to sleep on it. You can't just let it drift on the waves. You can contribute to retirement plans, your 401k or other equivalent type plans. If you're a young, immature person, do $17,000 a year. If you're seasoned and experienced, you can do $22,500. That's a major contribution you can make for yourself. And if your company does it, wow, that's terrific. If you're self-employed, even part-time self-employed, you can start your own contributory retirement plan in addition to your other employer's plans, as long as you don't violate a maximum, which is a pretty high maximum. ERISA guidelines, that's the law going back to 1974 that governs retirement plan management, stipulate that you're entitled to your benefits as long as you vest it. And usually that's done within 5 years. Nobody can take those benefits away from you. This is a really good thing. This is what's going to save Social Security, is a higher emphasis on contributory retirement plans. There are options if you leave your employer. You can see what they are. You can leave it with your previous employer. That's not necessarily a good deal because remember you have the wrapper costs that I talked about. Also, every time you want to do something, you're dealing with your old employer's plan, and that may not be mechanically feasible or even comfortable for you. You can take it out in cash. That's horrible. You'll lose upwards of 50% of your money because it'll be fully taxed and you'll pay 10% penalty on what you withdrew. And if you think about what I said when I emphasized and, you're paying a 10% penalty on the money you paid in taxes because the 10% penalty is on the whole thing, not the net after taxes. That's why you'll give away upwards of 50% of your money. Leave retirement plan, I covered. Roll it to a new employer's plan, that's a good deal. But again, they may have an expensive wrapper or they may have a limited menu of choices, so you need to evaluate that. and then rolling it to your own IRA rollover. That's the cheapest, most flexible, most widely optioned alternative, but you got to manage it properly. But when it's in the company plan, you have to manage it properly also. An IRA, this you can do yourself. And I mentioned earlier that the old annual IRAs should be the new annual IRAs. You can potentially deduct the contribution to your IRA. That's a traditional IRA I'm speaking of. You can do an IRA rollover, which is a terminal funding vehicle for any other retirement plan. You can also do a Roth IRA that I talked about before. The money goes in not before tax, after tax, but it grows tax-free forevermore. And I gave you the example of the planning opportunity with a Roth rollover. An IRA rollover is the best way to terminally fund a previous employer's plan, as long as you've selected the right vehicles and you're paying attention to it, or your advisor is paying attention. The traditional IRA can make sense. If you are maxing out your 401k and you still have surplus discretionary income, you need to consider doing a traditional IRA, even if it's not tax deductible. Why? Because the earnings are tax deferred. Remember, the money you don't pay in taxes today means a lot more money in the future. So it can make sense to do both. If you're choosing an IRA rollover, and this is a big deal, make sure it's a direct transfer from your employer's plan to the IRA rollover. Even if the check comes to you, it has to be made payable to the new custodian, whether it's your own IRA or your new employer's plan. Why? Because the IRS mandates a 10% withholding on any distribution that comes to you in your name, even if you intend to roll it over within the allowed 60-day period. Think about that. So in the example, here's a $200,000, excuse me, I said 10, I meant 20%. A $200,000 rollover, your employer sending the check to you. Remember all those boxes you had to check that was so confusing? They gave you 16 pages of forms and you had to decide, and it said, you know, remember, if you get this check made payable to you, we have to withhold. It doesn't happen often, but I've seen it happen. And I mean this, I've seen it happen. And once you check the wrong box and the check comes to you, you can't put the toothpaste back in the tube. Why? The employer had to send the money to the IRS that week at the time of withholding. So you can get it back if you do a rollover within 60 days. But you have to roll over 200,000, not 160. Because if you only roll over 160, 40,000 was considered a distribution, even though you paid it in taxes. And that will be subject to penalty. So it has to go directly from your old plan to your new custodian, either your new employer or your IRA rollover. Again, I say, if the check comes to you, that's okay, but it has to be made payable to. So when you check the box, they want to know who the new custodian is. That's important stuff, because it could be very costly if you do it the wrong way. You can do annual IRAs, and it may be tax deductible to you if your earnings are within under or within certain parameters. So if you're single and you're making less than $58,000, you can do a deductible IRA, even though you're doing a 401k. If it's between 58 and 68, it's partially deductible, depending on the percent. You go through those parameters. If it's over 68, you cannot do a deductible IRA, but you can still do a non-deductible IRA that later on, only the earnings will be taxable, but not currently taxable while they grow. So that can make sense to do. A Roth IRA is a good deal. Whatever you put in goes in after tax. So if you took, remember the example, your $100,000 401k plan now, and you fall down into a 15 or 10% bracket, consider doing a Roth IRA. I'm not telling you to do it, I'm telling you to evaluate doing it. And it may make sense to roll it over, because if you have a sufficient number of years, that 100 will grow to the example I gave you of 200 or 300, and now it's going to come out tax-free. So you did an advance payment at a bargain rate, so that no matter how it grows, you'll be 90 and you'll still be taking money out tax-free, and you'll have a lot more money as a result. You can convert your existing IRA to a Roth. Now there's a little wrinkle in the law. I don't want to take too much time on it. You cannot do an annual Roth IRA, meaning your contribution to a Roth, if you make over a certain amount of money. But you can do a contribution to a IRA and then later convert it to a Roth. So the rollover has no income restrictions. So you can get yourself to a Roth even though you may not be able to do an annual Roth. Okay, we're going to skip through quickly life's risks. The graphic is meant to show you some of life's risk. As the saying goes, stuff happens and we can't control it. We can ignore it, but that's one way of handling it, and that's a risky way of handling it. So let's take a look. Odds of occurrence, how much will it cost? Those are the decision points. What are the chances that this will occur? If it does occur, what will it cost me? Versus what is the cost of transferring that risk via an insurance policy? People don't approach insurance this way. So for example, I don't think we kept the example in, no. If I have a red Ferrari worth $200,000 and I drive it fast every day, well, the occurrence would be a high possible occurrence because it's a powerful car and I'm driving it fast, maybe irresponsibly every day. And it's expensive if something happens. I should insure that Ferrari. But if we have a Chevy Envoy with 145,000 miles, we drive it 1 mile each way to the park to walk the dogs, do I need to insure it? Well, yes, I do for liability, but I don't necessarily need to insure it for collision because the chance of something happening, because we drive it slowly, and it's only a short distance, and if it did happen, it's not that expensive to replace it, so maybe I shouldn't insure that. I'm not telling you not to insure it. I'm just saying that's the mentality of how we should seek, because otherwise we're paying money for insurance we don't need, and I'm going to tell a story on myself pretty soon here, that could be used to fund your IRA or fund your 401k. You see the difference? Those little bits and pieces all over the place make a difference in the aggregate. The risks associated with death. There are various risks. The obvious one is survivorship. If I die and I've got kids and a spouse who's not working, that's a big risk. If I'm single and I don't have anybody dependent on me, that's a different risk. So survivorship needs would be foremost. Secondly, I might die and there might be some death taxes. I say I will die and there might be some death taxes. We don't know what's happening in death taxes right now. I'm going to get this done by 4:30 and we'll talk about death taxes. But there are two vultures waiting on your tombstone to pick your bones. Big Bird and Little Bird. Big Bird is the federal government, Little Bird is the state government. Big Bird, people remember that metaphor. I've gone to funeral homes where people say, Big Bird, Little Bird, I remember that from class. Big Bird is arrogant. He will only bite you if you're financially fat enough. I'll give you those numbers. Little Bird is not arrogant. He has a much smaller beak, but he bites everybody. That's the state tax collector, death tax collector. We have both. They interplay, but you're probably going to have one. You may have both. All right, Big Bird gives you some credit for what you paid Little Bird. So the total ball of wax. Even if Big Bird's tax goes away, we still have Little Bird's tax. We still have income tax on heretofore not taxed assets, like your retirement plan, and we have estate cost. So there are exit fees for leaving this life if you've got any degree of success, and you have to account for those and plan for those and try to mitigate them. So the financial risks, survivorship, estate cost, and last would be business continuation. What if he and I are in business together? I die. I'll volunteer to go first. All right? You have to buy Janine out. Oh, by the way, you have to work twice as hard to earn the money to pay her. She might go to work for you. All right. But you see the point. Business continuation is an exit cost, too. So we need to consider all three of these as we're moving forward in our planning. Life insurance basics. Only two kinds of insurance, no matter how they package it. Term, which is in effect renting death protection. You're not owning it, you're renting it. That's okay. Most people just need term. And then permanent insurance, where you bought it. Term insurance is best used for survivorship, especially younger couples, because you can buy more with less money and protect your family. That's your intent. Permanent insurance should be used when the need is permanent. Estate cost. The older I get, the bigger my estate becomes potentially, and therefore the higher the cost. And I can't escape it, and I need the money when I die to pay the death taxes. That's a permanent need. Maybe there's a permanently dependent family member. I can't, that's not going to go away. That's a permanent need. So if my earnings are gone, that dependent family member needs to be subsidized. Business continuation or business buyout, that's another permanent need. We don't know when we're going to sell the business, which one's going to die. It's a permanent need. We need it when we die. It's not for family protection until the mortgage is paid and the kids are out of college. That's temporary. If we think about it that way, we make much more clear choices and spend money only where we need to. Let's look at the components of insurance costing. Just like manufacturing this cabinet, there's cost of goods sold. In the insurance sense, that's mortality cost. How many people in this room are going to die this year? Well, that's the insurance company's risk. That's what it costs them to deliver their product. Company expense, have to run the company, pay the salespeople, pay the help desk, run the internet site, buy paper clips, pay the light bill. Oh yeah, we got to make a profit. It's not a social service organization. So you tack a layer of what, 10% gross on top of everything? And it is definitely much less expensive as a result. But it works like this. Term insurance is a step. Once again, time, cost of insurance. 40 years old, 90 years old. Okay? Cost for a 40-year-old is here. Cost for a 90-year-old is here. So if I'm renting the insurance, the cost, my chances of dying grows tremendously as I get older. So the basic cost of the insurance has to go up. So every year I have more expensive insurance. Well, that's okay, because maybe I only need it from 40 until, let's call it 55. So I'm only paying from here to here. That's pretty good. So that's all I need. Done. End of story. Kids are educated, mortgage is paid, built some assets, spouse went back to work, don't need the insurance. All right? But what if I have one of those permanent needs that I just enumerated up there? Well, maybe I'm going to die at 90. I hope I don't die that young, but maybe I'm going to, go early. Then to keep that insurance permanently, what's it going to cost me for $1 million worth of insurance at age 90? Oh, about $950,000 a year, right? So I can't afford that. So I need to buy permanent insurance that at age 40 starts out here. So I'm going to overpay in the early years so that I can underpay. If I get lung cancer later, would you sue Expo? Okay. So that I can underpay in the later years. Why? That's not drawn to scale, but the illustration is correct. I'm overpaying so that I can underpay here. Why is this smaller than that? Because of the earnings rate on the cash value, the overpayment. In other words, the overpayment was warehoused and put on deposit at some earnings rate so that it then becomes available to fund the shortfall later on. That's why permanent insurance works that way. Now, there are different kinds of permanent insurance. The old-fashioned whole life, which is what our parents and grandparents owned, and then something called universal life that's based on a bond portfolio, and then variable universal life, which is based on a balanced portfolio. Which one do you think I favor? All right, but there is a cost structure, even more so than in a 401k, to wrap that contract. So there's certain costs involved in variable universal life. So you want to buy that when you've got a long period of time, then the earnings overcome the internal cost and you're far better off. So what you earn here in the overpayment years will determine how well this is funded later on. So if you have permanent need and you're a 40-year-old, you've got to look hard at a balanced portfolio that's going to totally cover this. Maybe you can even stop making premium payments later on if it earns well enough, because this cash value will fund it. It'll be finished and you don't have to pay for it anymore. But if I only need it temporarily, then I'm going to do this route. If I need it permanently, I'm going to start here and do this route. and I'm going to pick the right contract that goes in. So the understanding of permanent versus term is dependent upon, just like everything else in your financial makeup, you, your goals, your family responsibilities, your time frame, your risk tolerance level. See, it all works the same way. So survivorship, estate cost, disability. Here's Toby, my best buddy. He died a long time ago. He's here, aside from immortalizing him. I used Toby to illustrate a point. 25 years ago, Toby and I were running before dawn on an icy morning in South Park, and we decided to break my ankle. No, we didn't decide to break my ankle. What we decided was we were going to go out and run, and thought we were going to be as lucky as we were in previous other mornings and not break my ankle. But in fact, I did break my ankle, which was broken on both sides, and I had 6 months of operations and casts to put metal in, take metal out, walking around on a crutch. Well, nobody told me, nobody told those nice people I met in the emergency room that morning that I was going, or they were going to become disabled. See, no one says you're risking things. Think about what you do. When you're on your way home and you pick up your cell phone while you still have the other hand on the wheel, remember Toby. Right? We all do it. So disability happens. And disability can be financially worse than death because you're still alive and you're bringing a lot more expenses to the equation. And your chances of becoming disabled are far greater than your chances of dying at just about any age until you become quite elderly. So disability is an expensive proposition. Not only do you have lost income, you've got these other factors that come into play. You cannot self-fund disability unless you are very, very wealthy. So disability contracts, and I say this for a reason. You say, Bob, that's so evident. Why would you belabor it? Well, I taught a course some years ago for Westinghouse Financial. You might remember it. And it was populated by young MBAs with Hewlett-Packard 12Cs in their pocket and, you know, that sort of thing. And I said, how many of you are going to continue, because they were closing the company, and I was lecturing there for several months. And I said, how many of you are going to continue your COBRA coverage on life insurance? Well, half of them weren't married. They said they all put their hand up. How many of you are going to continue your disability on COBRA? They looked at each other. But their chances of becoming disabled and the financial repercussions were far greater. You're in a period of transition. Don't pick up your cell phone while you're driving. Don't take Toby for a run. You've got to continue that coverage. It's really important because the financial repercussions are severe. There are 6 contract considerations. This determines cost, and effectiveness. What's the benefit amount? How much you contract for? Most contracts are for 66 2/3% of your former earnings. Anybody here take a 1/3 cut in earnings with no problem? Okay, you see the point? And if your company paid for it, it's taxable when it comes in. If you paid for it, it's tax-free. The waiting period, how long? Well, if you're arranging your own contract and you can handle your expenses for 2-3 months, then you want a 90-day waiting period. It cuts the premium down. Duration of the benefit. Is it till age 65? Is it for 5 years? Sometimes your occupation determines that. And whether you're qualified for your own occupation or any for that which you could be suitably trained, don't be afraid of that second one. They're not going to make you sell newspapers on the corner. It's what your education and background and previous experience qualify you for. Premium cost, group versus individual. Group contracts are cheaper. Individual contracts are more expensive. But if you're, for example, an engineer who job shops and you're going from one contract job to another, maybe you should have your own disability contract because you're going to have many periods of dislocation in between in your career. So you need to consider all of this in your financial planning. I'm not teaching you about disability contracts. I'm teaching you how to think about disability contracts as you go through this period of transition. Long-term care. Think of that as disability for older people. But yet younger people end up in nursing homes too. This is different. Disability is to help you with the income that's been displaced and any attendant additional expenses. Long-term care is when you're in a nursing home or you have to be cared for at home. And they work the same way. The odds of having this happen to us, the older we get, become much, much greater. And yet, many people hold misconceptions. It'll never happen to me. I can depend on Medicaid. Medicare will pay the bill. I won't live long enough. None of those are true. Medicare, which is retired person's health insurance, does not pay for this. It pays for you in a skilled nursing center for a period of days after you've had the stroke, so you can come home. It does not pay for you to go into a nursing home for an extended stay. And those cost upwards of $100,000 a year. Anywhere from $60,000 to $100,000 a year. You need insurance to cover that. You need to test that, or in the trendy parlance, you need to stress test your assets to see if one of you can go in a nursing home and the other can still be sustained at home. If not, then you need to get the contracts. The younger you get them, the cheaper they are. And they have the same contract provisions as disability. Your odds of going into a nursing home are far greater than being in a major car crash or suffering a home fire. The fastest growing age group, the long-term care age group. Medicare only covers the short term, as I said. And this is the entry-level cost. That's without the extras like oxygen. Nobody's paying attention. That was a joke. Come on. Get some oxygen in the room. Medicaid, on the other hand, will pay for your nursing home stay. Medicaid is administered by the Department of Welfare and will only come into play after you've spent down all of your own assets. Are you depressed yet? I'm going to kill you pretty soon here when we talk about estate costs. See, it's the same moving parts to a contract as disability, and that's what you need to consider. So you can play with these variables based on your own situation to try to get the most favorable premium. Normally the premiums stay the same, but sometimes they change. But the company has to go to the insurance department and certify that their costs are such, and it's sort of like the gas company raising your rates. It has to go to the PUC. So it's pretty much the same thing. Estate planning. Estate planning is about accumulating, preserving, and then distributing. It's not just about old people who are going to die. As soon as you have our guys and gals going overseas have major estate planning considerations, don't they? What happens to their assets? What happens to the people they care about? What happens to their pets? What happens to a lot of things? It all goes into estate planning. It's your security and your family's security. And estate planning also includes if you were to become disabled or go into a nursing home. That's part of it. Big Bird counts everything you own, subtracts everything you owe, and adds in, you ready for this? Your life insurance. Everything, Big Bird and Little Bird, both count everything that's on this flow chart right now. But Big Bird, here are the two vultures, includes life insurance. Think about the implications of that. So life insurance, the insurance salesman who said this is free of inheritance tax, that was true. He meant Pennsylvania inheritance tax, not federal estate tax. So you can have a young couple with low assets and high insurance qualifying for federal death tax. Now, the good news is you pass to a spouse, there's no federal or state death tax. But pass it to the kids, pass it to other relatives, pass it to your favorite financial advisor. Okay. All right, delayed reaction. Pennsylvania does not count life insurance. Right now, there is a $5.12 million exemption for federal death tax. That's pretty good. So most people won't pay a federal death tax. But remember the formula? Everything you own minus everything you owe plus your life insurance. So if you have a successful convenience store and a retirement plan and a lawnmower, it all gets counted. And you can easily be over $5 million. And when you do, the tax starts at and ends at 35%. So if you leave $6 million, you're going to give away about $350,000 to the federal government for the privilege of dying. By the way, you paid income tax to accumulate those assets. And it doesn't matter how hard your kid worked in your convenience store to help you build the business. He or she still has to come up with $350,000 to keep the store. Kind of interesting. But it gets better. You see 2013? Okay. More about this in the debates. Once we have a nominee on the Republican side, this will heat up between the Democrats and the Republicans. So stay tuned is all I can tell you. We're not going to belabor this. There are ways that you can avoid. This is state death tax. Nothing when you leave to spouse or charities, 4.5 when you leave it to descendants, 12% when you leave it to your brother or sister. Isn't that interesting? Leave your car to your brother or sister, they have to pay 12%, and 15% when you leave it to me, your favorite financial advisor. All right, I'll pay it, don't worry. All right, nobody likes the taxes, don't be a crybaby, but there's steps that you can take. You can use a unified credit. Remember, that's the $5 million going down to $1 million. You can gift that during your lifetime and get it out of your estate if you have a large estate. So what are you gifting? You're putting it into a trust for the benefit of your family, but you're allowed to take the income from it. But what else are you doing? You're gifting future growth. So if you're a healthy 65-year-old and you're worth $10 million, you need to consider putting $5 million right now into a trust and gifting it and using your lifetime exemption. Because if you die in 20 years, that $5 million could potentially be 20. And you've now saved the federal death tax on $20 million. And you still have the other 5 to use as you will, plus the income on the 5 you put it in the trust. I'm not telling you to do it. I'm trying to give you a vivid illustration of how somebody who's been successful in their business can cut their taxes substantially. But again, it starts with you, your unique circumstance. Anything you do to gifting to individuals, you can gift money to family. It's with the parameters, $13,000 per year. So if you have 3 kids and 6 grandkids, you can do 9 times $13,000. And if you're married, your spouse can do the same thing. So you can start to get money out of your state if you have surplus money. If you don't have surplus money, you can't. You can also give any amount of money to charity. At death or during your life, nothing's taxed when you give it to charity, although some proposals recently would be to eliminate the charitable deductions. That's counterproductive, isn't it? And I had this conversation yesterday with a major foundation in town. That can you imagine how much more expensive society would be if there weren't foundations to do things? They're now picking up the bill for government in a large degree. Okay. You also may want to shift appreciated assets to lower tax bracket individuals. So if you're going to gift money to your grandson to go to college, maybe you should give him or her an appreciated security, because then he can sell it and not have any capital gains tax to pay because he doesn't have a tax bracket. Whereas if you sold it and gave him the money, you have to pay capital gains tax. So again, this is all integrated. Financial planning is fingers laced together. You don't make independent decisions. Charitable living trust. You can create charitable living trusts where you can derive the income and the principal goes to charity after your lifetime is over. But you get an immediate tax deduction, actuarially computed. They're wonderful techniques that if people have amassed assets of any size and want to benefit their family, benefit charities, you can have the tax code work for you. Big caution light. Don't gift until you're sure you can afford to gift. Don't be so worried about the boogeyman of taxes that you're going to hurt yourself later by having insufficient assets. That's where the schedules come in. That's where the planning comes in. Now you can make an informed decision. Now ask me the question, how often should you check your estate plan? Annually. Don't neglect it. Don't wait for tax law changes. Okay, investment goals, funding sources. Usually there's an imbalance. We have more goals than we have assets to fund, so you have to make discriminatory changes. And most common goals are, I want to educate my children, maybe help my grandchildren, and I want to retire comfortably. And maybe I want to leave a legacy to my kids, and maybe I want to give now or later some money to charities I care about. Those are the common goals that most people have. But as I said earlier, maybe you want to retire early and change careers. Maybe you want to take a year sabbatical and see the world. Maybe you want to stop working altogether and write the great American novel. That's okay. Whatever your goals are, that's what needs planning. But it's not going to happen by wishful thinking, and it's not going to happen by pretending not to know things. It all has to be put together into a comprehensive plan. So we look at the success factors are the rates of return, how we put it all together, the mix of investments that we use, both equity and fixed income, can include real estate, and real estate has tremendous benefits. Cash flow from rental income, deduction for depreciation, and inflation hedge, because all real estate goes up with inflation, and there can be potential real growth in the form of land development or improvement of properties. Take a rundown property, improve it, sell it or rent it, you get beyond inflation. Observations. They're typically leverage, which amplify both the risk and the reward, because if you put in $1 and you borrow $2 and buy $3 of real estate, it's the $3 of real estate that goes up in value. But then again, you have to pay back the $2. But it can work for you tremendously, but you got to know what you're doing. Mutual funds, I told you, are simply ways of owning asset categories. There are mutual funds in every asset category, and when you're picking them, you don't pick them solely on performance. What we do is we take every slice of the pie, and this is the funnel I told you I'd show you. You take all funds that are open without restriction, and only no-load funds. You don't need to pay a sales charge for a mutual fund. That's an antiquated way to acquire mutual funds. You don't need to pay somebody 5% to pick a fund for you. That doesn't mean you don't need advice. You probably do, but not that way at that expense level. Then you take the slice of the pie we're looking at, and in this example, it's large company value oriented, the Caterpillar tractors of the world. And we screen for the best funds operating in that category. So of now 23,000 mutual funds in existence, we're focusing right now on 600. 60 of those, as an example, and usually that's the case, the top 10%, will outperform their peers consistently. 20 of the 60 will do it with less than average risk, and 12 will do it with less than average expense. Now we have a selection menu of the best 12 out of 600. And we decide which 1 or 2 or 3 will go into our large cap value section. Now we move the dial over to large cap growth, and we do the same exercise. And small cap and mid cap and emerging markets and international Europe and international Asia. And we do it all the way around the pie chart. And now we put that extra 5% of value into the portfolio on top of the 92.5% from asset allocation. And then we do, you want to teach this one? It's coming up pretty soon. When we rebalance, just your question. Everyone's asset model will look different from the other. But the way you screen for each of these will be the same. So if we have international stocks, I may have more or less than you, but we're going to screen the same way that I just described it. And we're going to strategically, and we're going to have a world view. And we're going to put all of the right asset sectors in. And then we're going to keep an eye on them and make sure they're doing what they're supposed to do. And we're going to make 2 kinds of changes. One is a strategic change to our asset model, and the other will be tactical changes within the model itself, the investments. And they're different, but they're connected. The allocation changes with you. It doesn't change with the market. So if you retire, your allocation model may change. If you change jobs and have a lesser income or a greater income, your asset model may change. If children get married and leave, children come home and bring grandchildren after a divorce. All of those things, somebody becomes disabled, the model may change. It doesn't change with what you think the markets are going to do next quarter. Those are tactical changes. The strategic changes are all in the model, and those are based on life happenings. So your model will only change if you change, your circumstance changes. The tactical changes come from rebalancing back to the model and adjusting for economic changes. By that I mean where we are in the economic cycle. Maybe we're going to emphasize growth a little bit more than value. Or maybe we're going to become defensive and emphasize value over growth. Or maybe we see trends emerging in the world economy and we might add a little bit to our international exposure or decrease our exposure to Europe when certain things happen. That's different than timing markets. Those are fundamental economic investment management tactical changes. But the model's not going to change. It's just what we're populating the model with might change. So we rebalance back, and then we change the investments over time. So time, education, resources, personnel, judgment, experience. If you possess it, use it. If you don't, and this sounds self-serving, but it's true, hire it. This is not a do-it-yourself process. I used to say, you don't tune your own carburetor, and someone reminded me they don't have carburetors anymore. You see the point? You can't keep up with stuff unless it's your occupation. The right advisor makes all the difference. The guys all want her. She's not one of our employees. All right? And there are different ways that you can access advice. The traditional brokerage firms, which have been transactional. Those would be the Merrill Lynches of the world. Discount brokers. If you're equipped and able to mostly do it yourself, that's where you should go. Use a discount broker. You can use insurance agents, I would say, for insurance, not for investments. Banks can sometimes, some do a good job, some do a poor job. Accountants, the same. Independent advisors, my personal bias is the advisor who works for you, not the product person who's selling the company products. But you have to make your own decision, but that's the world from within which you will change. But interestingly, the public mushes it all together. I have many more times than once heard somebody say, my advisor is Northwest Mutual Life. No, it's not. That's your insurance salesperson. I bought the same brand of car for years, and we wanted to get a particular type of SUV. And this model, this brand of car, had a large SUV and a small SUV. We wanted a Goldilocks just right SUV, the midsize. They didn't make it. My salesman, who's a personal friend, spent 20 minutes trying to convince me why the big one or the small one would suit my needs. He wasn't working for me. He's working for the nameplate. So let's get that straight when we're looking at people who are selling us products. You want someone who's working for you as an independent advisor. And we could have created, I could have modeled my firm any way I wanted, and that is the right way to do it. Pros and cons, decision points, come back to what you need to know. Determine your life's goals. Do an analysis of your current situation. Create the right plan that's unique to you and your family unit to get you from here to there. Implement the plan. Monitor and adjust, that's strategically and tactically, and continue to keep yourself aware of what's going on. You do that, you're in the top tier of all investors, because most people don't exercise that kind of discipline in their financial planning. Whether you're in transition or after, this is the right way to go. Notice how we're coming out at just the right time? So, if anybody wants to talk, give me a call at the office. You have the card. Otherwise, get with your advisor. Talk about these concepts. This is mandatory. I didn't make them up. They're internationally recognized. So, thanks, guys. You've been a great class.